Good day, and welcome to Narayana's Weekly Wraps. I am Viv Govinder. This week, we're going to look at earnings season, particularly focusing on the banks as well as a couple AI chip stocks. Then we're going to take a look at the Genius Act, a wonderfully named bill by the Trump administration that's going to be dealing with cryptocurrencies, especially what's called stable coins. I'll describe what they are and what the important factor is going forward. We're going to have a look at what's been happening in the AI space in terms of startup companies and a big shift that might be important for those looking to invest in some of the smaller companies out there. Okay, let's start off with earnings. So earnings season just kicked off this week. Two big things that came out early in the week were some of the bank results. What we saw from them was a bit of a bifurcation. Investment was not doing that well, but they made a lot of money on trading, which kind of makes sense. I mean, if you look at just how volatile the last quarter has been with regards to, for instance, things like the Liberation Day as well as the recovery thereafter, I think that we are seeing a ideal kind of situation for traders where the big swings allow you to place big bets and obviously hopefully make big profits as well. But this has not been quite as positive for these banks in investment terms. So if you're looking at a company like, for instance, Goldman Sachs, very good results in terms of trading. JP Morgan, also good results with the trading, but the investment income was not quite as positive. We also had, like I mentioned, some results from some of these AI or chip companies that obviously use to make AI models, etc., and run them as well. The two big numbers that came out were from TSMC, which is the Taiwanese semiconductor manufacturing company, and ASML. Now, to understand what these companies do, ASML, what they do is they make the machines that are used to make the chips. Now, this is one of the really few true monopolies in the world for the really high-end machinery. ASML's machines are often worth multiple billions of dollars each. They are incredibly sophisticated. The Chinese government has been trying to basically, create something similar in their country for several years now, and they have not got close to it yet. The times in which they have, surprised the market in inverted commas with regards to some of the chips that have been produced, it later turned out that they have actually used some technology from ASMC, including machinery itself. I would say that, you have to look at the overall, most cutting edge companies out there in terms of what's at the absolute limit of what is possible physically. ASML is among those companies. Surprisingly, however, it's not translated really into a huge share performance. Not like, for instance, we've seen Nvidia, which has crossed $4 trillion in the last few days, or kind of performance even seen from TSMC. The released set of results from ASML have been reasonably good. Last quarter, they did reasonably good results. The fear around this company is that they highlighted geopolitical tensions. They highlighted basically some uncertainties about the future, and the market basically punished the company by dropping the share price 7%. TSMC, on the other hand, had better results of the last quarter, but the market has not been quite as fearful around them. I think this kind of dissonance about how the market treats ASML versus other companies is surprising. Like I said, you could replace it in Nvidia. You could even replace a TSMC if you had to. I don't think you could replace an ASML. Companies are trying to do that, or countries even are trying to do that, and they're not being able to succeed at it. That being said, they still have not been able to really generate the kind of huge profitability that we've seen from it, like an Nvidia. I do think that around some of their fears around geopolitical tensions, it may be overstated. Yes, the Trump administration has made many threats about chips, etc., and they've even put some of these things through, but they've never been like the most extreme, most worst case scenario tariffs or restrictions. And in fact, one of the reasons we saw Nvidia cross that $4 trillion level was because they recently pulled back on restrictions against China in terms of what could be exported to China. They allowed Nvidia and other companies to export a downgraded, kind of version of their best chips to the Chinese market. The idea here is simple. The Chinese economy is huge. The Chinese market is huge. If you ban Nvidia and other companies from exporting to China, all you're going to do is you're going to hand that entire market over to the Chinese chip makers. And I've talked about this before. If you don't believe that we're going to have AI or what's called AGI, whatever you want to call it, super intelligence or whatever you want to call it, in the next few years, this is one of the worst moves you can possibly make. You're effectively cutting off a huge chunk of market to your own local producers like Nvidia, and you're handing that entirely over to your adversaries, companies like Huawei. And in the longer term, what that's going to mean is that Huawei will have the ability to develop its own infrastructure, its own chip manufacturing, etc., to the level where it probably will eventually compete with the Nvidias of the world. The statement I heard somebody say, which is I think the idea here, is that what you're doing is you're selling muskets to the Chinese in order to stop them from developing an industry that can build machine guns. That's the idea. Whether it'll work or not, I don't know. The Chinese have shown themselves to be really, really good at like bootstrapping or even lower end hardware to basically achieve what they want to do in terms of model design, etc. Deep secret etc. showed that this is a very, very innovative sector in the Chinese economy, and they are able to do amazing things. And even like I said, Huawei produced chips, maybe with stolen technology or illicitly gotten technology, etc. But they still managed to produce chips that were farther ahead than most people had thought they would be able to. And it's quite possible that by allowing the Chinese to basically buy chips from Nvidia, which in short term might hobble Huawei, it will result in the Chinese AI sector going further ahead. And the thing to also note here is that if you're thinking that just cutting Huawei off from funds is one way to hobble them, I don't think that's a possibility. If they're able to succeed and they just need more funds, the government will step in and help them out. It's not going to be a case where the government say, "Oh, Huawei, you can't produce enough chips that are being sold at the moment because of the competition from Nvidia, and therefore don't progress." No, it's going to be, "Oh yeah, we'll use the chips from Nvidia. Huawei, continue. Yes, you're making a loss because you're not selling these chips because you are being outcompeted by Nvidia. Doesn't matter. Go ahead, produce what you need to produce, invest what you need to invest, and we'll backstop you." And that, I think, is more likely to be the outcome going forward. Now, moving on to the Genius Act. Now, the Genius Act refers to a particular part of crypto called stablecoins. Now, what stablecoins are is that you have a cryptocurrency that's been created that's backed entirely on a one-to-one basis by a hard currency. In this case, usually the US dollar. The most famous company that does this is a company called Tether. Now, the weird thing about this is that the law kind of prevents you as the company that provides the stable coin from paying an interest on the stable coin. And so the way the business model works is this: people go and give dollars to Tether. Tether takes those dollars and gives you back Tether. Then you take those Tethers and you transfer it to somebody else across the world or wherever you want to transfer it. That person gets that Tether, then goes back and sells them and gets coins or gets the dollars, right? Often there's a gap between the point at which you buy the Tether stable coin and the point at which you sell it. Now remember, this coin is directly linked to the US dollar. There is nothing extra here. The ideal situation is that you give them $1 for a coin, you get that coin, and then you sell the coin and get exactly $1 for it. That is what you're getting. Now, if you can imagine, if you do enough business around something like this here, you as Tether are holding at any point in time a lot of money, billions of dollars in regards to Tether. And what can you do with billions of dollars? You can put it in the bank and at an interest rate. That's what they do. So Tether is basically, its business model is effectively providing these stable coins, making sure that the coins that you buy and sell are exactly linked to the US dollar. And then while you basically buy and sell them that little intervening period, and they have access to those funds, they keep those funds in interest-bearing or income earning accounts and make a fortune. And actually, by law, they're not allowed to give you that money. And so it's like, it's free money. So that is the current kind of situation. Unfortunately, this rule does not, or this law does not change that particular part of that rule. What it does do is it means that coins that are used in the US dollar are going to be, regulated in the US. This, I think, is probably a good idea. We've seen in the past where these stable coins have, been abused, where they're not being backed on a one-to-one basis, and that's resulted in losses by investors or users. Let me say rather, you're not investing. You don't invest when you buy a US dollar. You just basically have a US dollar, and they're not really investing here. They really want to use this mostly for transactions, etc. And this would basically mean that there's more regulation around this. What the future holds, I don't know exactly for companies like Tether. Will they be able to, or willing to, submit themselves to U.S. administration and U.S.-like regulations, or will they say, no, rather stay outside? If they do stay outside, they might be more, useful for, non-U.S. citizens, but it might just cut a big chunk of the market that they might want to access. So it all depends on what their future plans are. But I think in terms of stability for the market, this is probably a good thing going forward. Now moving on to developments in the AI startup space. There's a company called Windsurf. Windsurf basically is a startup company. I'm not going to go into details of what exactly it does, but it's a startup company focused in the AI space. They had technology, they had founders, they had a valuation of around $3 billion. And they were going to be bought out by OpenAI. Now, OpenAI, for those that don't know, make ChatGPT is the leading, LLM provider out there, almost as much as everybody else combined. They are doing more than Google and Anthropic and all the other smaller guys combined almost. So they're by far the leader in the space. And they were looking to buy Windsurf because they thought some of the technology would fit in well with what they did. Now, I'm not going to go into details, like I said, what Windsurf does, but that was the idea. Unfortunately, when OpenAI was a smaller company, they made a deal with Microsoft, including saying that any technology that they get, what they develop internally, what they buy, etc., Microsoft gets immediate access to until AI is developed, or AGI is developed rather. And that was a problem here because there are things that Microsoft does that competes directly with what Windsurf does, and it would not have been a favorable investment for OpenAI had they done that. And so the $3 billion valuation seemed to have basically probably been good, and probably OpenAI could have bought it. I remember OpenAI, despite being a startup, despite making massive losses, is a multi-$100 billion company at the moment, and is easily able to go out and buy a company for $3 billion if the technology is correct. And so Windsurf OpenAI deal kind of fell apart, and then who steps in? Alphabet/Google, and they buy it, or rather they don't. What they do is they offer $2.4 billion to the CEO, the management, and about 40 or so of their best engineers, and take them out of the company. And that is what the difference is about this particular transaction that we've seen in the past. We've come to a point right now where founders of companies are being offered such insane amounts of money, and top engineers are being offered such insane amounts of money, that it maybe no longer makes sense to start your own company. Like, think of in the past, like you have Mark Zuckerberg, or you have a Sergey Brin and Larry Page and so on. They start Google. Why remain in charge of Google? Why not go get a job at Apple or Google or Microsoft or something like that? Why would you stay at Google? Why would you stay at Facebook as Mark Zuckerberg and so on? Well, one of the reasons is basically you get a lot more money. And I'm not saying that these AI founders are going to get as much money working for Google as they would have maybe with a successful AI company. But not every AI company makes a success. Not every startup turns out to be a successful company. And often you fail and you back to basically starting up again. But even when you fail, sometimes you get a bit of a payout coming through, and you do get a bit of money coming through. But if you do succeed, you're making in some cases like Brin and Page and like Zuckerberg and so on, hundreds of billions of dollars. Now, in the old days, when the alternative to the hundreds of billions of dollars was effectively a couple $1 million working for Microsoft, etc., or a few $100,000 a year working for Microsoft, etc. No, it's a very good deal to basically go out and start your own company and stay focused on that. Nowadays, however, you're not being offered a couple of 100,000. You're not being offered a couple $1 million. You're being offered in some cases hundreds of millions of dollars to come and work. That's a very different a proposal. This is more than in some cases like a CEO like Tim Cook is making per year. So, in a situation in which you have an AI company that may or may not work, in which you are being offered, in this case, $2.5 billion effectively among about less than 50 people. Well, in that scenario, what you do is you go across, because when you're making hundreds of millions of dollars, as an employee, a guaranteed income coming in. That is life-changing money. That is what a moderately successful startup company would pay out to the founders. I think that's in the region of what, like a guy like Brian Johnson, the guy that does that "Don't Die" kind of thing, who made with Venmo. It was in the region of a few $100 million. That's what you're getting paid as a salary here, without the risk of your company going under, without the stress of managing the company. Just as a worker for a Google, for in this case Meta as well. With what they did recently, where they hired the head of It was Apple's AI team for like a couple $100 million. They hired about, a few, like half a dozen or more of OpenAI's people for around about $200 million a person. In that scenario, you are getting a guaranteed salary, money in the bank, no risk. You have money that, in all likelihood, if you work for a few years, you're making, hundreds of millions of dollars. Okay, to give you an idea what the kind of packages they're looking at, some guys being offered the following package: $100 million signing bonus in your money in your hand, $100 million annual salary. Again, just work a year and you get another $100 million. And in addition to that, a $300 million potential bonus per year, $500 million potentially. You know what I mean? If things work out. If they don't work out, 1 year working plus signing bonus, that's $200 million. That's a lot of money. That's enough to, have generational wealth. That's kind of, if you think about it realistically, more than you could spend. Now, why is this important? If you've come to a point right now where the amount of money being offered to work for a big tech company is really competitive, in some cases more attractive than being the CEO of a reasonably successful startup, the startup space is going to look very different going forward, because you're going to be finding that you're not going to have, the potential new Apples or potentially like Googles or Facebooks, etc. What you're not going to have, even Apples rather, you're going to have, Steve Jobs being hired by IBM or Mark Zuckerberg being hired by, Microsoft, etc. for huge amounts of money. And, remember back in the day, there was a talk of for instance, I think Google, the Google guys are willing to sell their company out for like $1 million. There was talks about Facebook for like $1 billion, as potential exits. The amount of money Brendan would have gotten for $100 million, for $1 million is obviously nothing. But let's say even if it's $1 billion, I mean, that's a big exit for these guys. They would probably not have gotten much more than the offers right now in terms of income, in terms of the income that earn as employees of these companies. So if that is the case, then you're likely to see a lot of the more attractive, more innovative AI companies out there, especially things like that are just about starting off yet and haven't really proven themselves into the market yet. A lot of that talent is going to be stolen by the big companies, which could mean that we are not likely to see the next Apple emerging to challenge a IBM or the next Google emerging to challenge a Microsoft. You could very well just see all the best tech or technology guys being hired by these big companies before they make these companies into great new competitors. And the weird thing is this, that in the past, if you go and try and buy a company like Windsurf, etc., antitrust rules, you go and try and hire the people, the law turns totally from being against you to actually being for you. Why? Because there's restrictions on trade that are illegal. Hiring a person is a very different story from buying a company. The law doesn't want you to buy a company because of lack of competition. The law prevents people from restricting you from hiring a person because that's infringing on their rights. So it's actually a case in which it's going to be very difficult for the government to step in and stop these companies from doing that. Maybe at the upper end of management, like CEO level, you can't do that. But when it comes to engineers, when it comes to the top, tech talent in the company, I don't know if there's going to be a way for the government to step in and stop, for instance, a Microsoft or a Google from just plundering the best, or Meta from plundering the best technologists from these startup companies. And, in a space like this here, the best minds are what's going to be developing the next technologies. Okay, that's it for this week. Thanks for joining me. I look forward to speaking again next week. Cheers.